it's a big welcome here from TFR to Kris from Broekhoven, who heads up Citi's Commodities Trade Finance division. And I thought I'd take the opportunity to find out what your thoughts are on a very different commodities trade finance space. We've got $1.5 trillion worth of business here, and the Eurozone banks are coming back after some time out. And we've all been seeing the headlines how there's been a general sell-off from some of the trade banks of their commodities trading assets. So what do you think this landscape means for trade bankers like Citi now, Kris?
Okay, thanks, Clarissa. So first of all, let's make a distinction between banks who actually trade commodities and banks who finance the trade of commodities.
Right.
So where we've seen the biggest change in recent months actually is where the banks who used to have significant presence in commodity trading are gradually exiting that business. We've seen Morgan Stanley, JP Morgan, Deutsche Bank, UBS, Barclays earlier today on the news. So as a result of regulatory pressure, these banks have to focus on other businesses and they sell their trading platforms. Now what does that create is, in my opinion, an opportunity for the other group of the banks, which is the banks that actually finance the commodity traders. Yeah. Because we're seeing large trading companies being created from scratch, and they all need financing.
So basically, is what you're saying that because the trading source of liquidity is no longer there from the way it used to be, they're having to be a bit more creative and have rather different conversations with banks like yourselves. Can you tell me a bit about those conversations?
It's actually there's a necessity for them to exit the business because they're not allowed to be a player in commodity trading anymore.
Yeah.
So that's why they sell. Then the conversations they turn obviously to those investors who are interested in buying those assets.
Right.
And we just have those. We've seen private equity step up. We've seen traditional commodity trading companies step up, or we've seen even producers stepping up to buy these assets. Okay. So that's where the conversations take place, because they obviously need financing and they need to get the lines in place, which is why they need to talk to commodity trade finance banks.
Okay. One of the things that struck us here at TFR was the Citi Trade Maps deal that's won an award in our Deals of the Year. And although that was mainly receivables finance, that model of packaging up assets and educating investors, how do you see that perhaps being rolled forward into commodity finance?
Okay, that's interesting. So the trade maps deal is just one example, I think, of the new trends in this market today. Generally, you see banks and trading houses, our clients, that do the same thing, diversify their sources of financing. And what is happening is that you actually banks, especially, have been trying to find an opportunity to match investor appetite.
Yeah.
Right, more kind of debt capital market types investors, pension funds, etc., to actually meet the parties that actually need the financing, just like the trade finance banks and the commodity traders, for example. So trade maps as a receivables securitization is a good example, and we believe there will be many more of those deals because it really satisfies one of the needs that exists today.
Okay. So what are your thoughts going forward over, say, the next 12 to 18 months on the shape of the commodities finance landscape to come? It's very different from the place it's been, isn't it?
Yes and no. So you have new players entering the market, like ourselves, like at Citibank as well.
Yeah.
You see kind of Chinese banks stepping up, Japanese banks, regional players. We've seen regional African banks or Asian banks playing a more prominent role in commodity trade finance transactions, etc. So you see a new type of players, and we've seen others kind of being a bit less confident compared to a few years ago, right? Like mainly the Eurozone banks who've been focusing on shrinking balance sheet, etc. Liquidity has returned back to the market, but the playing field has changed slightly.
Let's just take a look at those regional banks in frontier markets like Africa. They don't have the balance sheet. So how are you working with those on-the-ground experts at ensuring liquidity is still flowing into those regions?
Okay, so first of all, you're right. So the regional banks that do not have the balance sheet that is we're used to seeing in the more international financing banks. But they do have an appetite for a certain type of financing. So obviously, like when we talk about the African banks, they're the natural kind of player in an Africa-related funded transaction. One of the gaps that they fill is not so much liquidity, but is the fact that many of us banks, international banks, are quite distracted by regulatory change, and it does put some constraints on the business, and has definitely slowed down the credit approval process, and has some of the banks made less predictable in whether they can get their approvals or not compared to before. And that's where you see that the regional players can be a bit more agile than the international players.
Okay. Thanks very much, Kris. It's been great talking to you. I look forward to seeing you again soon.
Pleasure. Thanks, Cloris.